Nature of financial management. This lecture is very important for those who are doing MBA, BBA, and those who are practicing finance in real world. Let's discuss what is financial management. Financial management meaning and scope. The financial management is a managerial activity focused on planning and controlling of a firm's financial resources. This is a branch of economics and is still evolving field. This is very important field for academicians and the people those who are practicing finance as manager. For academician, it is important because it is a still evolving field and there are controversies on topics like cost of capital and time value of money, which creates a further huge scope for research. And people, those who are practicing financial management, because they have to make critical decisions in their managerial life, they need to learn the concept and analytical tool for the sound decision making for their business. Core concept of corporate finance. There are three core concepts of corporate finance. First is asset classification, second is capital dynamic, and third is funding and ownership structure. The asset classification, the real asset and financial asset. The real asset are basically classified in two categories. First is tangible asset and second is intangible asset. Tangible assets are plants, machinery, buildings, which are physical assets which we can touch. Okay, and the next is intangible asset like patents, copyright, trademark, and technical know-how. Then comes financial asset. Assets are shares, bonds, debentures, funds operations. And second is capital market dynamics. Capital market is divided into two parts. First is primary market, second is secondary market. Primary market is where the firm issue new security to raise necessary funds. Secondary market where these securities are traded. Stock exchange. Third point is fund and ownership structure. It has two components. First is equity fund, second is borrowed fund, which is also called debts. Equity funds raised by selling shares. Shareholders are the legal owner of expecting return via dividend or capital gains. The second is borrowed fund. Borrowed funds are loan taken from the institution on which we have to pay interest. That is cost of capital. So for equity, cost of capital is dividend or capital gain, and for borrowed fund, the cost of capital is interest. Now, long-term financial decision. A finance function or decision have to make longer time horizon, generally greater than a year, affecting firms' long-term performance and value. Decision those who are made for the capital of the company for the longer horizon of time, generally for greater than a year, are called long-term financial decision. These are three financial long-term decision. First is investment decision, second is financing decision, third is dividend decision. In investment decision, we have to decide where the capital will be allocated, in which project the capital is going to be allocated. We have to decide through analysis, evaluation, and ranking of project in terms of internal rate of return. So we have to decide which project is going to be more profitable and where we have to allocate our capital for future best returns. Second is financing decision. Financing decision, we have to determine the best capital mix, the best capital structure, the optimum capital structure, which is a mix of equity and borrowed funds. The third is dividend decision. In dividend decision, a finance manager has to decide whether the shareholders are getting dividend or we are going to retain the earning for further capital formation. Now, the short-term financing decision. The short-term finance decision are the decision which are made for the shorter period, which is usually for less than 1 year. Decision regarding cash, sh- short-term assets, short-term borrowings to maintain liquidity or to save company from getting illiquidity condition. The key role of a finance manager. The key roles are divided into six broad categories. First is strategic planning. In strategic planning, a project manager or finance manager has to decide where we are going to allocate our funds to get more and more return on the basis of analysis, evaluation, and the ranking. Second is financial reporting and analysis. A finance manager has to ensure understanding of financial reports, conduct analysis, and ensure the compliance with the financial regulation. And the third role is profit planning and forecasting. Finance manager has to estimate future revenues, expense to guide the budgeting and financial planning. The third role is day-to-day management, day-to-day treasury management. Manager manages working capital, cash flow, liquidity for the smooth operations of the business. The another one is raising, managing funds. Determine the best mix of equity and debt for funding operation and growth. The last is cost control, monitoring the control cost to improve the profitability and operation. This is all about the financial management, short term, long term goal, what is financial management, and role of a finance manager. Hope you like this session. If you know more about the finance,